Good day, fellow investors. As you might know, we have this YouTube educational portfolio and we're going to do the monthly review now. We're going to go through the portfolio performance, the strategies, the outlook. We'll discuss the transactions that I have made related to that portfolio today. But before we start, I want to discuss what is investing and managing a portfolio to give a better grasp on what this educational portfolio is. Because as you see, we have a few stocks. I have to add more learning experiences here. But one of those stocks is Intel. And I have discussed here part of the Intel investing saga, and that also explains risk and reward when it comes to investing and how it fits you. Remiel here says, if it's accounting fraud and a red flag for you, why not simply close the position? First, I have no position. This is an educational portfolio and we follow a lot of things. Over time, we should do well in a diversified portfolio. And if you look at Intel here, we are investing or following here to understand the semiconductor cycle, which means that we follow Intel, but we might buy something else or similarly. Here there was a great reply by Richard and his thought on the comments and how many people are perhaps missing the point. This is an educational portfolio. It is about learning. Whether Intel goes up or down, it's irrelevant. This was a great learning experience and not a waste of time. There are 3 lessons here. It's okay to bring a CEO for growth as long as everything is growing. So a minus for Pat there now. And this is perhaps the most important thing. You got to follow a stock to learn about it. What makes the stock tick? If we look at Intel, what made it tick? The dismal, destructive earnings didn't really make it tick much. The tick happened already, let's say, more than a year ago as the growth stories in general disappeared. But now what has happened was likely already expected. And you can feel that only if you own a stock like Intel. And now I'm thinking it didn't tick much here. So this level here might be close to some kind of first bottom, and now it's up to you to understand the risk and reward if you want to risk the second bottom, dividend cut, and more bad news, or you think already, well, it might tick up from here. And as Richard said, you've got to follow a stock to learn about it, what makes it tick. You have to understand the risk and reward, and you have to understand especially this. The best buys for an investment portfolio are when it's ugly that it can't get uglier. At some moment in time, that will be the case for Intel, and that will be the best buy. That's why we need to follow. And then when you get info, accounting or this, you have to weigh that info to see how it fits the whole story. Because I see a lot in the comments, there is so much emotions, people forget the real reasons for owning. For example, here Sergi discussed how he has a big position, it's a bummer, emotions, but he thinks it should recover sooner or later, it is possible, it's Intel. And now, not many companies like this one on the product side. If Intel fails, then all the Occidental world will depend on the totalitarian China, so to speak. Well, on some things that's already the case, so not really a change there. Chips should be good and improving businesses. He doesn't understand here the semiconductor cycle. So my problem is I started buying too soon and it's been falling since then. Ouch, more emotion. Anyway, we will watch it how it goes. If the reasons for owning change or something like that, you might see how the risk and reward fits you. Why is Intel still in the portfolio to answer here? Because the risk and reward, now that the stock price is lower, the stock isn't ticking on the dismal earnings, now one might think, okay, we are getting closer to something interesting. And I really want to follow the semi situation and think about it. Think about the portfolio, the 20 positions there. If we follow 20 positions there, some of them at some point in time will get us the right tick to buy something great for our long-term portfolio. And I have discussed Intel 4 months ago, so that's when we bought, and it is flat since then. Intel, again, its value, it is a buy, but only in 2025. So this is the strategy. The current discussion on the accounting, let's say changing or window dressing, however you want to call it. This was back 2 years ago when Intel had its earnings, dividends, buybacks. I did buy it at 49. I did sell it when the story changed because I bought it for earnings, dividends, and buybacks. And then they told me we are the next growth story. Well, thank you, goodbye. And then again, Intel is a buy here at 45, understanding the risk and reward of the story, of the cycle. And a buy means that the likelihood for long-term upside is positive. It is still paying a dividend. And there can always happen ugly things when things like the last 6 months happen, as we have seen. That is investing. And we want to learn about businesses over time, and that will lead us to owning a few forever. If you check, one of my most important videos is about Buffett buying 10 stocks and then likely selling 9 out of those 10 and holding just to 1 out of 10 for the long term. He also needs to own it to understand it. Also, Russ here commenting, you don't have much of a loss. That's anchoring. The loss or the gains don't mean much. Why don't you sell and put the money to use elsewhere? Because I'm not going to sell when it looks ugly. I'm going to sell when it looks great, as you'll see later in the portfolio. So this is the portfolio. We're going to manage it. Let's discuss the performance. This is early morning, February 2023. You'll later see it live. We started with 1 million a few months ago, mid-2022. We are now 16.5% up. This is the portfolio. We have had 2 trades since now. The Tesla hunch short closed that, and the Devro that got acquired. And let's simply start here, stock by stock. Warner Bros. Discovery. Look at the strategy here, spin-off, AT&T shareholders selling because they don't know better, no dividends there, and we bought and we waited. Now the stock is doing a little bit better. This could be from people expecting things to do better on the February 23rd earnings, but you never know about that. For me in the portfolio, it is a significant position, but a hold, and we'll see how it develops over time. Rubis Oil, unloved company, also doing okay, paying a fat dividend. We'll update that on earnings. Newmont, our gold story. I had to sell it when it was recently at 55, and I didn't because I just didn't manage to sell it here for the YouTube portfolio. But I had to sell it now. I didn't manage. Now the stock price is down again. So the strategy, all-weather strategy there, where we bought first here, and then we said if it goes lower, we simply buy more. And then if we get back to this price, I should sell this. I was sleeping, or let's say better, I was working on something else, so I didn't manage to catch that point. But okay, that's the strategy there. Then we have Facebook, Meta platforms. We are going to trim a little bit the position. Don't remember when we bought here. Now it is up significantly, as suddenly also Mark Zuckerberg pushed the stock higher. And I made a video here 3 months ago how at 99 the stock is too cheap, and someone reacted immediately, Sven Karlin is wrong on Meta. Well, since then the stock is up more than 100%, so the poor idiot learned his lesson. I'm not wrong. Of course, just joking here. I can be right or wrong on any position, or I can't, because I always look at the risk and reward, what can happen, what's the upside, what's the downside. Nobody can predict the future. I can't predict what will happen. So on some I will be wrong, on some I will be right. That's immaterial to me. I'm joking, of course, about the idiot part. But that's the message here. We want to analyze the risk and reward, and that's exactly why I'm going to trim Facebook a little bit, because nothing changed there except for Mark Zuckerberg's pleasing Wall Street in the fundamentals of the business, and therefore the stock price is double, which means that the risk is higher, the returns are lower. Let's look at the earnings. Okay, revenues just a little bit down, no crash, no disaster. Expenses flat there. Net income, okay, they made some money. Of course, compared to a year ago, it looks terrible, but still, the market cap was 250 billion just a while ago, and even with terrible situation like now, they will still make 20 billion, which is a P ratio of what, 10, 12. And if we look at the conference call, Mark went for efficiency, efficiency, efficiency. And if you search in the transcript, one of 33 matches for the word efficiency. So in this case, Mark Zuckerberg really went up the of Wall Street to push the stock price higher. So Mark decided to please Wall Street, focus on efficiency, profits, and less on touting how great the meta platforms of the future are. And that did well. Of course, he's still spending a lot of money on the meta platforms, but pleasing Wall Street, saying how he will focus, spend 5 billion less than expected, and do what is more important now than the real long-term picture. Okay, Facebook is up 100%. And this also explains the risk and reward taken here when I bought, what was priced in, and when the things that cannot go bad anymore are priced in or not priced in, then you take action because the risk is much lower. As I said in that video, too cheap. So too cheap for what it offers in potential, and that people are still using it. So I didn't invest personally because I hate Facebook, but that's personal. That's, again, emotional, but that's a different story. Let's go to the next stock. I think we bought this ETF just to follow China, to educate. Okay, let's make a panic buy and buy on the China noise, because as we have seen a comment before, we depend on China. So that's the reality there, whether you like it or not. So I bought there, follow it. I will trim it now. I will get the profits in because nothing changed with China. It's just up significantly. Okay, not as far as it can go, but if I trim here, the next trim, when it comes here, I will then trim again, maybe in a few years, you never know, but that's the strategy there. Intel, we discussed the semi-cycle. We're going to follow Google, good price, fair business. We just had earnings. The stock is up a little bit, but the growth has stopped a little bit with Google. We'll see the same later for Amazon, Apple. So that is something significant, and that is another reason why you want to follow these things, because it gives you a sense of where the economy is, what's going on. So our position is stable there, nothing bad. Berkshire will make an update when earnings come out. We have Amazon, net sales still up, still doing good, so still powerful, but nobody likes this because, like Mark, Jeff is also spending his money on building, building, building. Of course, they are trying to please Wall Street, but not really climbing up Wall Street's behinds like Mark is, because Jeff doesn't need it. It looks like Mark needs it more, but he doesn't care. He's just doing his business. He has his customers, growing forward and spending double what Mark is on development. And the market cap is 1 trillion. If you look at what he's doing, well, it's getting on the cheaper side. We are, of course, following it here just a little bit in the positive, and you never know what can make it a greater buy, and when that happens, we'll increase the position. ADM will wait for earnings, has climbed down a little bit, I think it was too overvalued a little bit there, but we'll discuss this in another video. And then we have Apple here. As you can see here, I consider Apple extremely overpriced, and therefore you see just a $6,000 position on the 1 million portfolio just to follow it there. And it's funny that out of all of the positions here, the only one losing is Apple. But if we look at the quarter, they are installing 2 billion devices, services are growing, and when they sell services are growing, it means other things are not growing, down 5% in revenues. But let me show you what is priced in when it comes to Apple. The first revenue decline since 2018, but still making a lot of money, going from 100 billion in profits to just 5% lower. However, if we look at the estimates, so this is expected by analysts, so flat for 2023, but then again forward just growth and then doubling earnings per share in the next 8 years. But of course, this is Wall Street. The projections are usually up to a year to 2 years, and you can see how they will go for 10% growth rate, and that is what is priced with Apple. I think that this is wrong. They were projecting the 10% also last year. As you can see here, it hasn't happened. It isn't happening. So I think that this might be too exuberant a little bit, because when it comes to Apple, if you pay a P ratio of 20-25, you are estimating that the growth will continue forever, which we all know is impossible. Miracles can happen, but at some point also miracles slow down. So with the current situation in the economy, there might be better opportunities for buying Apple, maybe not a P ratio of 10 like we have had in 2016, but maybe it will happen again. Over time, if earnings drop to 50 billion, it will trade at a trillion, and then if it can go back, you have a P ratio of 10 for a great business, and that's why we follow it. So now, transaction, let me trim these positions. All right, so interactive brokers, what do we have here? I said I will trim Meta. I think I'm 25,000 up. Let me sell 125, 140 stocks, 25,000. Let me submit it, and that's one order partially filled, order filled. That's done. And I said I will sell 60,000 of this, so 64,000. Okay, submit, and just to trimming the risk and reward. We're going to sell. It will likely fill in later. Let me just give you the account, the portfolio here. So you can see here now we have taken some profits, a little bit more now that the order is filled. Let me just refresh this. Oh, here we go. Unrealized profits and loss. Oh no, it didn't refresh yet. It should refresh a little bit. Oh no, this is just on the part that is sold. Okay. We have different values, but here we are. Now it's 1156 for the day. Okay, nothing new there. So my conclusion is that investing is not easy, and that's the main reason why we are doing here. But as Charlie Munger says, why would investing be easy? Anyone would get rich then. So follow, subscribe, smash that like button if you enjoy. Hope my cold goes away soon, and I'll see you in the next video.